Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Novo Nordisk.
If you find our talks useful, please consider subscribe, like, and comment underneath. Sometimes the market generates a scenario that just genuinely demands a double take.
Oh, absolutely.
Right. You stare at the charts, you review the institutional block trades, and you kind of have to recalibrate your entire perspective on an industry leader. We are looking at a structural valuation reset of an absolute pharmaceutical titan here. Novo Nordisk has plummeted nearly 58% from its 2024 highs.
Yeah, it's brutal.
It really is. As you sit there looking at your portfolio right now, the stock is trading in the mid-$30 range. It's scraping right against its 52-week low of $35.12.
The destruction of market capitalization here is just staggering. We are witnessing one of the most aggressive downward repricings of a mega-cap healthcare stock in recent history. The prevailing market sentiment has shifted from, euphoria to outright capitulation.
Completely. And that leads us to the core question we are answering for you today. Are you looking at a fundamentally broken business model, or are we staring at a generational asymmetric entry point for long-term wealth building? Okay, let's unpack this, because to accurately project where this stock is heading over the next 12 to 24 months, you first have to understand the severe underlying shift in their business model.
Right, the transition.
Exactly. They're actively transitioning away from that parabolic explosive growth and settling into a highly resilient, volume-driven defensive strategy. And, well, the market historically hates the initial phase of that transition.
It absolutely does, yeah, because the investor base that buys a hypergrowth stock is very, very different from the investor base that holds a mature cash-flowing value stock. That transition period is messy.
Very messy.
And you can see it playing out right in the 2025 revenue numbers. Total revenue for the year hit 309 billion Danish kroner, which that translates to roughly 45.9 billion US dollars. So that represents a 10% year-over-year increase.
But in the context of their previous trajectory, a 10% increase feels like slamming on the brakes.
Oh, for sure.
Back in 2023, they were posting 30% growth rates. When a stock is priced for 30% perpetual growth and the reality comes in at 10, the institutional algorithms just punish the multiple severely.
Precisely. The multiple compression is ruthless. However, if you ignore the multiple for a second and just, look at the actual operational demand, that 10% growth on a base of nearly $46 billion shows incredible structural resilience.
Right.
The obesity care segment specifically remains a dominant engine. In 2024, Wegovy sales alone surged 73.9%.
Wow.
Yeah, to hit $8 billion. The underlying demand hasn't evaporated, right? The rate of acceleration has just normalized as the denominator gets larger.
Right. The law of large numbers always kicks in eventually. But management clearly sees the writing on the wall regarding this deceleration. And they're executing some aggressive operational pivots to defend their turf.
They are.
Wait, hold on. This is where I need to push back a little bit. They recently introduced a brand new subscription model for Wegovy, offering tiered discounts if a patient commits to a 3, 6, or 12-month prescription.
Yeah, the new pricing tiers.
Right. But when a company suddenly starts discounting a premium product and trying to lock people into subscriptions, isn't that a massive red flag? It screams to me that organic demand is drying up and they are desperate to stop patients from defecting.
What's fascinating here is that it actually solves the single biggest structural flaw in the GLP-1 market, which is patient adherence.
Okay, how so?
Well, if we look at the current healthcare landscape, only 12% of eligible U.S. patients are actively taking these therapies.
Only 12.
Just 12. That leaves an 88% untapped total addressable market. But the historical data reveals a massive vulnerability. Patients on these drugs experience significant drop-off rates right around month 3 or month 4.
Wait, why month 3? Is it purely the out-of-pocket cost fatigue hitting them, or are the side effects just too much to handle long-term?
It's really a combination of both. So the titration schedule, meaning the process of slowly increasing the dosage to minimize gastrointestinal side effects, is difficult for many people.
Right, the nausea and everything.
Exactly. Right around the time they hit the maximum maintenance dose, the side effects peak. And simultaneously, the cumulative out-of-pocket costs for cash-paying patients become psychologically burdensome. So they quit right before the most significant weight loss benefits actually compound.
Ah, I see. So by implementing a software-as-a-service style subscription model, they're fundamentally altering the behavioral economics of the patient.
Yes, exactly.
If you are a patient and you've pre-committed to a 6-month, heavily discounted tier, you are financially incentivized to push through that uncomfortable month 3 barrier.
You've got it. You are converting a high-turn, month-to-month transactional model into highly predictable, long-term recurring revenue. By sacrificing a slight percentage of the margin per unit through these tiered discounts, they captured drastically higher lifetime value per patient.
Which makes sense.
Yeah, in a market shifting toward pricing competition, retaining a patient for 12 months at a lower margin is, frankly, infinitely more profitable than losing them to a competitor at month 3.
That recurring revenue predictability is exactly what dictates a higher valuation multiple over the long run. But pivoting to a volume-driven, SaaS-like model in the pharmaceutical world requires a completely different logistical backbone than, say, a software company.
Oh, absolutely. You can't just spin up more servers.
Right. If you are locking millions of patients into 12-month recurring prescriptions, your supply chain cannot fail. A single stockout breaks that entire subscription promise, which means you need massive capital to secure physical infrastructure.
Which brings us directly to their capital structure and why they're uniquely equipped to survive a protracted pricing war. They currently operate with a fortress balance sheet. They're holding $5.1 billion in cash against $15.9 billion in total debt.
Giving them a debt-to-equity ratio of just 0.61.
Exactly.
And their free cash flow generation is running at over $10 billion annually.
It's massive. Furthermore, their interest coverage ratio exceeds 19x, meaning their operating profits can cover their debt obligations 19 times over.
Wow. 19 times.
Yeah. So in an environment where the cost of capital is elevated, having zero solvency concerns allows management to play offense while their highly leveraged competitors are forced to play defense. And that massive cash flow safely supports a dividend yield of roughly 4.87%.
They're operating at a very sustainable payout ratio, about 50%.
Very, very safe. Okay, so here's where it gets really interesting. Because they aren't just sitting on that cash flow or using it solely for dividends, they recently deployed it to execute an $11.7 billion acquisition of Catalent's fill-finish sites.
A huge move.
It is, but now I have to challenge this strategy.
Right.
I mean, the broader trend in pharma and biotech over the last decade has been to go asset-light.
Outsource the heavy lifting, keep the intellectual property, maintain those high margins. Dropping almost $12 billion on physical manufacturing facilities seems like a massive, bloated capital expense that will just drag down return on invested capital. Why buy the factories?
Well, to understand the necessity of that acquisition, you really have to look at the specific bottleneck of this industry. The active pharmaceutical ingredient, the raw drug itself, is not the primary bottleneck.
It's not.
No, the bottleneck is the fill-finish process. This is the highly complex, heavily regulated final manufacturing step where the biological drug is safely injected into those sterile automated delivery pens.
Ah, okay. So it's the exact point of constraint in the global supply chain.
Exactly.
If you don't control the fill-finish, you don't control your output, no matter how much raw drug you synthesize in the lab.
Precisely. For the last 3 years, whoever could simply manufacture the pens could sell them. But as the industry shifts from being supply constrained to being aggressively pricing competitive, securing that vertical integration is not a bloated expense. It is the establishment of a wide economic moat.
That makes total sense.
Yeah, by owning Catalent's fill-finish sites outright, they secure their own proprietary supply chain and actively deny that manufacturing capacity to their competitors.
Wow. You control your own destiny and simultaneously squeeze the logistical capacity of the broader market. And once you have the drug in the patient's hands, the actual biological nature of the treatment creates another defensive layer, right?
Yes, the titration process we discussed earlier creates incredibly high switching costs. If a patient is successfully stabilized on a high-maintenance dose of Wegovy and decides they want to switch to a competitor's drug to save a few dollars...
They can't just swap medications overnight.
Right, they cannot. They typically have to start the uncomfortable, multi-month titration process from scratch with the new drug. That biological friction effectively locks users into the Novo Nordisk ecosystem once they are stabilized.
So they have a fortress balance sheet, they own the absolute bottleneck of the supply chain with the fill-finish sites, and they have a sticky, SaaS-like biological product.
Very sticky.
It sounds bulletproof on paper. But we have to address the core thesis of the bears right now, because the main reason this stock has been cut in half from its highs is the intense, escalating battle with Eli Lilly.
Yes, the competitive dynamic has fundamentally shifted, and Eli Lilly is executing flawlessly.
They currently dominate with roughly 60% of the U.S. GLP-1 market. But the real threat isn't just their existing injectable market share.
No, it's the pill.
Exactly. They just launched an oral obesity pill called Foundayo, and they aggressively priced it at $149 a month. How on earth does an expensive cold-chained injected biological drug from Novo Nordisk financially compete long-term against a cheap, easily manufactured daily pill? It seems like this fundamentally breaks Novo's pricing power.
It is a severe threat, I won't deny that, but the market's reaction assumes Novo Nordisk was caught completely off guard, which is factually incorrect. Novo Nordisk actually secured a critical first-mover advantage in the oral GLP-1 space.
They did.
Yeah, they launched the Wegovy pill back in January 2026.
Okay, but a pill versus a pill, what is their specific strategy to maintain volume against Lilly's aggressive $149 price point?
Their strategic target is the approximately 85 million Americans who are categorized as needle averse.
No, that's a huge demographic.
Massive. It's a demographic that desires the metabolic benefits of the drug, but has an insurmountable psychological barrier to self-administering a weekly injection. By launching the oral version of Wegovy months ahead of Lilly's mass saturation, Novo Nordisk has been actively capturing and locking in this specific demographic.
Because of those biological switching costs we just discussed.
Exactly. Once an oral patient stabilizes on the Wegovy pill, the likelihood of them enduring a new titration cycle just to switch to Foundayo drops significantly.
And this intense fight for market share has resulted in a massive pricing divergence in the broader market. Because Eli Lilly and Novo Nordisk essentially operate as a duopoly in this space, right?
Right.
Yet they're being valued under completely different paradigms.
Completely.
Right now, investors are paying a massive premium for Eli Lilly, which is trading at a price-to-earnings ratio of over 30x. But Novo Nordisk has been punished so severely that it is currently trading at just 11x forward earnings.
And to contextualize that multiple, the broader healthcare sector average is currently sitting at 17.3x. So Novo Nordisk is trading at a deep structural discount, not just to its primary rival, but to the entire healthcare industry.
It's wild.
The market is pricing the stock as if terminal decline is a mathematical certainty.
Which is exactly the type of setup that triggers heavy institutional accumulation. If you look at the recent filings, we are seeing major whale activity that completely contradicts the retail panic.
Oh, the whales are definitely buying.
Aberdeen Group recently increased its stake by an astounding 231.4%, just aggressively buying an additional 429,351 shares in the fourth quarter alone.
Yeah, when institutions of that magnitude increase a position by over 200%, it signals extreme conviction that the technical floor has been established.
Right.
They recognize that the worst-case scenario has already been fully baked into the valuation, and they are acquiring a best-in-class operator at a steep discount.
So what does this all mean for your portfolio strategy over the next quarter? We have a depressed valuation, a fortress balance sheet, and institutions quietly buying the dip. What are the specific near-term events that could force the broader market to wake up and cause the stock to rebound?
Well, there are several distinct catalysts on the horizon. First, we are seeing crucial regulatory shifts that directly impact their unit economics. The European Medicines Agency just approved Wegovy for room temperature delivery.
Wait, let's break down the mechanics of that. Previously, these drugs required strict cold chain logistics, right?
Right, constant refrigeration.
They had to be kept refrigerated from the moment they left the factory onto specialized temperature-controlled pallets into refrigerated trucks all the way to the pharmacy shelf. Breaking that cold chain requirement isn't just convenient, it fundamentally alters their profit margins in Europe.
It entirely removes a massive layer of logistical friction and cost. Without the cold chain requirement, distribution channels widen dramatically. You can utilize standard shipping, which vastly opens up direct-to-consumer and mail-order pharmacy distribution across the European continent. It drives down the cost per unit and accelerates volume simultaneously.
That's huge.
Yeah.
And alongside that, the UK's health guidance body, NZ, officially recommended Wegovy for preventing heart attacks and strokes.
Yes.
This is the crucial narrative shift. We are moving away from the perception of this being a cosmetic lifestyle drug and cementing it as a life-saving preventative cardiovascular measure that immediately forces national health systems and private insurers to rethink coverage.
Absolutely.
That NICE recommendation alone added about 1.2 million eligible people to their addressable market in the UK.
And that expansion of insurance coverage based on cardiovascular outcomes is the ultimate key to unlocking the remaining 88% of the market. But looking at the immediate calendar, the most volatile catalyst will be the upcoming Q1 2026 earnings report in May.
And this is going to be a psychological battleground. Management has already broadcasted to the street that 2026 is going to be a trough year. They have officially guided for a 5 to 13% sales decline, attributing it to the intense pricing pressures from Eli Lilly and the loss of some regional exclusivity rights.
Right. But if we connect this to the bigger picture, the certainty of that decline is exactly why the stock is sitting at $37. The market has completely priced in the trough.
The expectations are sitting on the floor.
Precisely. Therefore, the mechanics for a severe upward price correction are firmly in place. Because sentiment is so toxic, if they report in May and demonstrate any unexpected strength, if the subscription model yields higher retention than projected, or if the uptake of the oral Wegovy pill shows robust volume, it forces a violent repricing.
If you have massive short interest built up from the recent downtrend, if the narrative shifts even slightly positive, all those short sellers are forced to buy shares on the open market to cover their positions, creating a cascade of buying pressure. And beyond the earnings desk, you have macroeconomic tailwinds aligning perfectly for a defensive stock like this.
Absolutely. If we look at the broader macro environment, inflation is proving to be incredibly sticky. The recent CPI data revealed the biggest jump in inflation since June 2022.
And when inflation runs hot and rate cuts get pushed back, institutional capital rotates rapidly. It drains out of speculative, high-multiple growth sectors and floods into defensive safe havens.
Right.
Portfolio managers look for healthcare stocks that have impenetrable balance sheets, high free cash flow, and reliable dividends. With Novo Nordisk offering a near 5% dividend yield, a 0.61x debt-to-equity ratio, and an 11x forward multiple, it is perfectly engineered to absorb those defensive capital inflows.
And we cannot ignore their internal scientific engine either. Over the next 3 months, we are expecting critical Phase 3 data readouts for their next-generation pipeline assets, specifically CagriSema and amycretin. Oh, right.
Positive efficacy data there instantly reminds the market that their intellectual property pipeline extends far beyond the current iteration of Wegovy. When you synthesize the entire landscape, the deeply compressed valuation, the strategic pivot to highly retentive subscription models, the vertical integration of their supply chain, and the macroeconomic rotation into defensive yield, the investment thesis becomes highly compelling. We are assigning this an 8 out of 10 bullish score.
The narrative of the fallen giant has completely overshadowed the underlying financial reality. The pain of the competitive pricing pressure is already reflected in the sub-$40 share price. What the market is completely ignoring is their capacity for long-term volume dominance.
Exactly.
You have the opportunity to acquire a best-in-class pharmaceutical operator protected by a wide economic moat, trading at a decade-low valuation. For a long-term time horizon of 12 to 24 months, the risks-to-reward profile here is incredibly asymmetric.
This raises an important question, though, one that challenges the core assumptions of every analyst currently modeling this sector.
Well, the entire forward-looking valuation for both Novo Nordisk and Eli Lilly is predicated on current definitions of their total addressable market. But what if those baseline models are fundamentally flawed?
Flawed how?
Right now, the eligible market is largely defined by standard BMI metrics. However, emerging metabolic science suggests that if we adjust the criteria to focus on visceral fat, the toxic fat surrounding internal organs that drives cardiovascular disease, the true prevalence of the underlying condition is closer to 70% of the population.
Wow. 70%.
Yeah. If the scientific consensus shifts to treat visceral fat regardless of external BMI, are investors drastically underestimating the true ceiling of this market? Even with two massive titans fighting a fierce pricing war, the sheer scale of the eventual demand might eclipse anything currently projected on Wall Street.